Hey everyone, back to casual today. I'm not sure if I'm gonna keep up with the wearing a dress shirt on these videos like the last couple of videos. We'll see about that. So today I want to talk about mind medicine, the psychedelics play that everyone's kind of interested in. It seems like people are interested in mind med more than the other psychedelic plays, the other psychedelic companies like Field Trip, Compass, Cybin, GH Research, even things like Johnson and Johnson. Basically, you could look at the PSYK, not PSYKE. I said that in my previous videos. That was incorrect. It's PSYK. That's the Horizons ETF for psychedelics. It's basically the first psychedelic ETF, and you could just follow like their top 10, top 12 holdings, and you could see that they obviously have mind medicine as a pretty significant holding. I believe right around 10% is where MindMed stands now. Of course, it's not their biggest holding. I think GH Research, surprising to me, was their biggest holding the last time I checked. But MindMed has always been and probably will be a core holding of theirs. Um, but of course, this is not financial advice. I'm about to tell you the biggest risk to MindMed. What's the biggest risk to MindMed? And this is not financial advice. As I've said before, this is infotainment. And really, you can't really be taking financial advice from people online because that advice, first of all, isn't tailored and personal to you. And they have no responsibility towards you. And on top of that, of course, you have no idea if they're giving you good advice or crappy advice. So that plays a factor as well. Be careful with this, and be careful online. Always filter everything through your own understanding, your own risk tolerance, age, income, um, investing capability to understand, anxiety level as the baseline anxiety level you have. All that matters for investing. You have to manage all that because investing is hard, and investing is complex, and it's surely not intuitive. So acknowledge this for what it is, which is basically infotainment. um, but so you have a situation um, where everyone's into MindMed. They're into the other stocks as well, of course, and some of the other plays have higher market caps. But there's a big risk to MindMed, and really, the same risk that I'm going to talk about for MindMed generally applies to all these other psychedelic plays. So there's one overarching enormous risk, right? You could talk about all kinds of risks in all kinds of equities, right? There's always risks in whatever stocks you buy. If you want a risk-free return, then you would have to buy a risk-free asset, and that return would be quite low, especially today. And of course, it would be lower than a risky return, right? So there's different types of risks that you're exposed to when you invest in equities. Very simply, one of them is called market risk, broad market risk. It's another way to put it would be systematic risk. Not again, not systemic risk. That's important, but systematic risk. That's how you call it. It's systematic risk or market-wide risk. Another way to say it, there's different ways to say it, would be non-diversifiable risk. So if I say right now I'm thinking about systematic risk. It's the same thing as saying right now I'm thinking about market risk, which is the same thing as saying right now I'm thinking about non-diversifiable risk. Again, non-diversifiable risk, that risk which you cannot diversify away, that risk which you are going to be exposed to, even if you buy every single stock in the whole world, you're still going to be exposed to that type of risk, specifically market risk, non-diversifiable risk, right? You can't diversify it away. You'll never diversify it away. That's one type of risk. That's the risk that shit happens big time in the whole economy, that there's a global recession, global depression, or a local recession within your country, like a recession or depression in the US. A real and true risk, an important risk to consider, a really important risk to think about. Because even if you can't diversify it away, you could still avoid it. You could still avoid it by taking hedging and mitigating actions. Really, I don't want to call it hedging. The more appropriate word would be mitigating actions. You can take mitigating actions, like for example, not having 100% of your portfolio in stocks. You can have some in bonds, which obviously, over the last few decades, I don't know how well bonds performed. I'm not too much of a fan of bonds, but you could do bonds, you could do gold, you could do cash, you could do crypto, you could do real estate. in each of those, you're still exposed to a certain level of non-diversifiable risk, actually. Say there's World War III and just everyone becomes poor. All the wealth we have now, all the riches we have now in the Western world and the civilized world just goes away. Well, you can't do anything about it. Very little you could do to diversify that away. You could take mitigating steps, mitigating actions, accommodating actions beforehand to create a more robust existence, a more robust portfolio, and a more robust life. But you'll never be non-exposed to the risk. Oh, I'm no longer exposed to it. No, you'll still be exposed to that risk. You're in a more robust situation. Then there's another type of risk. So let's put this non-diversifiable market type risk aside, and let's talk about what's called company-specific risk. Also, there's a bunch of words for it. Here are the words. Diversifiable risk. You can diversify it away. Company-specific risk, and the one I like most is idiosyncratic risk. It just means specific to a unique thing. It's a very interesting term, and it's a term you could use a lot, actually. Look it up. Idiosyncratic. Idiosyncratic, company-specific, firm-specific risk. Whatever firm I pick, whatever I do, whatever equity I pick, there's certain risk that's just in the firm. Just in the firm. And you could, literally, you could pick the best company in the world, Apple, and you still, even in that well-managed, well-run, really robust company with very low debt or maybe no debt at all, a ton of cash and reserves, even that kind of low-risk company still has idiosyncratic or firm-specific risk. Management could fuck up. They can mess up their balance sheet. Their product fit can no longer be what it was in the past. A lot of things can happen with that company. Regulatory burdens and pressures can impact that company or the industry that company is in. So there's a lot of things that can happen to impact a particular company. And if I invest in Apple or any company in the world, I'm exposed to both risks, both idiosyncratic and market-wide, both firm-specific and non-diversifiable risk, both diversifiable and non-diversifiable risk. I'm going to be exposed to both company-specific risk and systematic risk, no matter what, if I invest in Apple. Now, the first type of risk, the company-specific risk, I can diminish it over time until we only have the single risk left, which is basically the firm-specific risk. No, I'm sorry, it's not the firm-specific risk. It would be the obviously the idiosyncratic risk. That's what it will be. So you would just have the idiosyncratic risk left. What am I saying here? No, you would diversify away the idiosyncratic and you would only have the non-idiosyncratic, the systematic risk. Again, two risks. This one we're saying is the idiosyncratic risk, and this one we're saying is the systematic risk, the non-diversifiable risk, the market risk. Period. The overall risk, the risk that you're exposed to even if you're invested in every company. You can get rid of the diversifiable risk by diversifying, by literally having a diverse portfolio so you're not just exposed to one company. You can get rid of that, but you still can't get rid of the non-diversifiable market risk. You can't get rid of systematic risk. You're always going to be exposed to it. So that's an intro to how I think about risk and the what I believe is a prudent starting point for thinking about risk. So MindMed, of course, it faces systematic risk. We don't really need to talk about that right now. We know that if the world becomes poor, all stocks will do well. So let's put that aside. Now I'm going to talk about an idiosyncratic risk that MindMed is exposed to, but it's not exposed to that risk on its own. It's not exposed by itself, where Field Trip and GH Research and Atai and Compass, they're not exposed to it. Only MindMed is exposed to it. No, that would be silly. That's not true. They're all exposed to it because the entire industry is exposed to it, and that's the psychedelic, the nascent, the new psychedelic industry that's being born, the psychedelic therapy, psychedelic medicines industry, and where you have companies that are putting forward therapies, new medicines, some of them synthetic, some of them based on just the ancient medicines that humans have used in the past. They're putting them forward. Some of them are in phase 1 trials. Some of them are in phase 2 trials. I don't think any of them are in phase 3 yet. I don't think, except maybe some intranasal ketamine sprays. And I don't think they're real psychedelics. They're not in the same league. as the other therapies that are in stage 1 and stage 2. So you have these things happening, but what can happen? What can happen to fuck us up? All the dreams and hopes we have for MindMed and every other psychedelic company. What can happen? Well, easy. Whatever happened in the 60s and 70s can happen again. Remember what happened then? When the US government basically cracked down big time on psychedelics. Where I think Nixon said drugs are America's worst enemies or something to that effect. They basically wiped psilocybin, wiped LSD, and wiped the idea of psychedelic therapies away from the US for 2 entire generations. 2 real generations were deluded and confused and not able to access these amazing therapies. We're still not really able to do it, but hopefully the next generation and onward will. But the government could come back and just say, no, we're not doing it. The FDA could say we're not approving it. The culture can shift, where the culture becomes more stodgy or conservative. I don't even want to use the word conservative because that's not the right word. More stupid, really. More confused, really. More dark. And where we also do what we did in the 60s and 70s, where we say we're not interested in these drugs as a society anymore, where we're not interested in having these medicines anymore. That's basically what society did, right? The government did it, but it's society that did it. If society really wanted to, the government couldn't stop them. So that's a big risk, and that's the biggest risk. People are ignoring it too much. They're ignoring it like it's not going to happen, and they're treating it like sometimes as if it's not a real risk, and then sometimes they're treating it as if it's a systematic risk or a market type risk, a non-diversifiable risk, which is not true. You can decrease your exposure to that by not investing so much in psychedelics and by diversifying. It's not true because that risk is only affecting companies in the psychedelic space. Only psychedelic based companies are exposed to that risk. Apple isn't exposed to that risk, right? The risk that we're going to change as a society, that government's going to crack down again on these things. It seems plausible that can happen. But Apple's not exposed to it because they're not interested in having a psychedelic medicine practice, in either developing them or distributing them or providing facilities where people can take them. That's not the business they're in. So they're not exposed to that risk. Who is? Who is exposed to it? Well, all these psychedelic companies, including MindMed. And that's a real risk. If that happens, MindMed is gone. Field Trip is gone. All these companies are gone completely. They're going to go to zero right away.